Have you ever thought about making a really significant gift, to a cause you really care about?
Yeah, something maybe beyond just writing a check.
Exactly. Maybe if it's a big cash donation, or maybe something more substantial, like valuable property, or maybe even a collection you own.
It's a great feeling to consider that.
It is, but almost right away, doesn't your mind jump to the practical side? Like,
Yeah.
okay, wait, how does this actually affect my taxes?
Absolutely. It's a very common question. That world of charitable contributions, the deductions, the limits, it can feel, well, complex.
Like navigating a maze sometimes. Welcome to the deep dive. This is where we take those dense topics, unpack them, and really try to pull out the useful insights for you.
Making it understandable, making it practical.
That's the goal. Make you well-informed quickly. Now, before we dive deeper, just a quick reminder. The show draws its material from Farhat lectures.
That's right.
All the content, the examples, explanations, it's all derived from the accounting resources over at farhatlectures.com.
It's a really comprehensive source.
Definitely. So whether you're an accounting student, maybe studying for the CPA exam, or already a professional, I'd really recommend checking out the website.
Yeah, lots of practice questions, video lectures, good support material to back up what we talk about here.
And special thanks to Professor Farhat for providing all this valuable material.
Indeed.
Okay, so let's get into it. Our mission today is cutting through the jargon around deducting charitable contributions.
Getting to the core of it.
Yes. We really want to focus on two key things. What type of property you donate, and maybe surprisingly, the ceiling on your generosity.
Because Congress does encourage giving, but yeah, there are definitely limits.
Right. So let's start with the basics. When we talk about charitable contributions, it's clearly more than just cash, isn't it? What are the main categories we should understand first?
You got it. It's definitely broader than cash. At a high level, think of three main buckets. Cash itself, then something called ordinary income property, and finally, capital gain property.
Okay. Ordinary income property and capital gain property.
Exactly. And knowing which is really crucial because it changes how you calculate that tax deduction.
So cash is straightforward, I assume.
Yeah, cash is easy. Valued at its face amount, no complications there. But ordinary income property, or OIP, that's different.
Okay. What falls into that OIP category?
OIP refers to assets that, if you had sold them instead of donating them, would have generated ordinary income or short-term capital gain.
Ah, short-term gain.
Right. So think about maybe a business donating inventory, or for an individual, maybe stocks or bonds you held for less than a year.
Okay, so if you sold those stocks quickly, the profit is short-term, making the stock OIP for donation purposes.
Precisely.
So for that ordinary income property, how do you figure out the deductible amount? What's the rule there? Maybe an example would help.
Good question. The key rule for OIP is this. Your deduction is generally the lower of the property's adjusted basis, basically what you paid for it, or its current fair market value.
Lower of basis
Yeah.
or FMV.
Oh, right. It kind of prevents you from deducting a paper loss through a donation. Let's use an example, say, Alex and his stock.
Perfect.
Alex buys stock for $4,000. He holds it for, let's say, 6 months, so less than a year. Then he decides to donate it.
Okay.
Now, scenario one. On the day he donates it, the stock's fair market value is up to $5,500.
Nice game for him if he sold it.
Right. But since he held it short-term, it's OIP. So even though it's worth $5,500, his deduction is limited to his basis.
Which was $4,000?
Exactly. $4,000 deduction. You can't deduct that unrealized short-term gain.
Got it. What about the other way around?
Okay, scenario two. Stock price dropped. On donation day, the fair market value is only $3,000.
Ouch.
Yeah. So here, the rule kicks in again, lower of basis, $4,000 or FMV, $3,000. His deduction is limited to the $3,000 fair market value.
So he can't deduct the $4,000 basis if the value went down.
Correct. It stops you from getting a tax break for a loss by donating it, essentially. If you sold it, you'd realize a $1,000 loss, but you don't get to claim that via a charitable deduction.
That makes sense. Prevents sort of a backdoor loss deduction. Okay, let's switch gears. Capital gain property, or CGP.
Right.
This is typically assets held long enough for long-term capital gain stocks, held over a year, maybe real estate used in business.
Exactly. Section 1231 assets, long-term stocks and bonds, things like that. And the general rule here is usually much more favorable. You can often deduct the full fair market value.
Which sounds great. Deducting the appreciated value seems very generous.
It is, but as you hinted, here's where things get interesting. There are a couple of really important exceptions where you don't get to deduct the full FMV, even for long-term property.
Ah, plot twists. What are these exceptions we need to watch out for?
Spot on. There are two key ones that can really change the calculation, limiting you back down to the adjusted basis.
Okay, what's the first one?
The first exception involves donating tangible personal property. So something physical you can touch that the charity doesn't use for its main charitable purpose, its exempt function.
Tangible property, not used for its purpose. All right.
Like
Yeah.
what? Think of donating a valuable painting, maybe a classic car or a rare coin collection. If the charity receiving it, say a homeless shelter, isn't going to use that painting in its operations.
All right, they're probably going to sell it.
Exactly. If they plan to sell it to raise funds rather than using it directly for their charitable work, then your deduction is limited to your basis, not the higher FMV.
Can you give us an example?
Sure. Let's use Oliver and his painting. Oliver bought a painting years ago for $5,000. It's now appraised at $50,000, clearly long-term capital gain property.
Big appreciation.
Huge. He decides to donate it to the Red Cross. Now, the Red Cross does amazing work, but displaying art isn't their core mission, their exempt function.
They'll sell the painting for disaster relief funds.
Precisely.
Yeah.
Because they're selling it, Oliver's deduction is capped at his original $5,000 basis, not the $50,000 FMV.
Wow, that's a massive difference.
It really is. Now, contrast that. What if Oliver donated that same painting to, say, a local art museum?
And the museum puts it on display.
Right. Displaying art is the museum's exempt function. In that case, Oliver could deduct the full $50,000 fair market value.
So where it goes and what they do with it is critical.
Absolutely. And usually the charity will tell the donor their intention, whether they'll use it or sell it. That's vital info.
Fascinating. So the charity's use is key for tangible property. What's the second big exception to the FMV rule for capital gain property?
The second exception relates to contributions of capital gain property made to certain types of private foundations, specifically private non-operating foundations.
Okay, private foundation, that term comes up a lot, maybe like the Gates Foundation, but then you said non-operating. How do we tell the difference and why does it matter for deductions?
That's a really important distinction. So private foundations generally are funded by a smaller number of sources, a family, a corporation, unlike public charities that get broad public support. Within that, you have operating and non-operating. An operating private foundation is actively carrying out its own charitable programs. Think of a private museum, a research institute run by a foundation. They're doing the work directly.
Hands-on charity work.
Exactly. They spend a good chunk of their income directly on their mission. A non-operating private foundation, however, often functions more like a holding tank or a grant maker.
So they might receive donations and then give grants to other charities.
Correct. Or they might just maintain a specific asset, like a historical park, but not run broader programs. They aren't operating in that same active sense.
I see the difference.
So the rule is, if you donate capital gain property to one of these non-operating private foundations, your deduction is limited to the adjusted basis of the property, assuming the basis is lower than the FMV.
Back to basis again. Can we have an example for this one too?
Let's use Maggie and her land. Maggie bought some investment land 5 years ago for $10,000. Today, it's worth $30,000.
Yeah.
Long-term capital gain potential. She decides to donate it to a private foundation that primarily makes grants to environmental causes. So it's a non-operating foundation.
Okay.
Even though the land is worth $30,000, her deduction is limited to her $10,000 basis because the recipient is a private non-operating foundation.
But if she gave that same land to, say, a public charity like the Nature Conservancy, or maybe even a private operating foundation that ran its own conservation programs,
Then she could deduct the full $30,000 fair market value. It's another situation where the recipient organization type dramatically changes the tax outcome for the donor.
it really highlights how crucial it is to know the status of the charity you're giving to. It's not just about your own asset.
It absolutely pays to do that homework.
Okay, so we have different types of property, different rules for valuation, exceptions based on use and recipient. There must be an overall cap on how much you can deduct each year, right? Based on your income.
Exactly. Generosity is encouraged, but Uncle Sam does put a ceiling on it based on your adjusted gross income, your AGI.
And these limits often relate back to the type of charity, doesn't it? You mentioned public charities versus private foundations.
That's right. We often talk about 50% organizations, which are typically public charities, and 30% organizations, which often refer to those private non-operating foundations we just discussed. These percentages relate to the AGI limits.
Okay, let's break down those AGI limits. What if you're donating to a public charity or maybe one of those private operating foundations? What are the ceilings?
All right. For cash donations to these public charities, private operating foundations, the general limit is 50% of your AGI. However,
Uh-oh, another
a
twist.
helpful one this time. The Tax Cuts and Jobs Act temporarily boosted that limit to 60% of AGI for cash gifts, specifically for the tax years 2018 through 2025.
Ah, so right now it's 60% for cash to public charities. Good to know.
Yes. Now, for ordinary income property donated to these same 50% organizations, the limit is 50% of AGI, using that lower of basis or FMV value we talked about earlier.
Okay, 50% for OIP.
And for long-term capital gain property donated to these public operating charities, the limit is generally 30% of your AGI, calculated using the fair market value, unless one of those exceptions forces you back to basis.
So 60% for cash currently, 50% for OIP, 30% for CGP when giving to public charities or operating foundations.
You got it.
Now, what about donating to those private non-operating foundations? You said the limits are generally lower?
That's right, consistently lower across the board for those. For cash to a private non-operating foundation, the limit is 30% of AGI.
Okay, 30%.
For ordinary income property to them, it's also 30% of AGI.
Still 30%.
And for long-term capital gain property donated to a private non-operating foundation, the limit drops again, down to 20% of your AGI.
20%. Wow.
Yeah, you can sort of see the pattern, right? The tax code generally provides higher limits, more incentive for donations going to organizations with broader public reach and direct activity.
It definitely seems structured that way. Okay, so let's say someone is incredibly generous and their donation amount, even after applying these rules, is still more than the AGI percentage limit allows for that year. What happens then? Is the excess deduction just loss?
Thankfully, no, it doesn't just disappear. This is where carry forwards come into play.
Ah, carry forwards. Good news.
Very good news. If your contributions exceed your AGI limit for the year, you can carry forward that excess amount and potentially deduct it in future years.
How long do you get?
You can carry it forward for up to 5 years.
5 years. Okay. Does it keep its character? Like if it was 30% property that got limited?
Excellent question. Yes, it does. A carry forward from a 30% property donation remains subject to the 30% limit in the carry forward years. It keeps its original classification.
And how do you use them? Do you use the carry forward first or current year donations?
You always deduct your current year contributions first, up to their respective limits. Then, if you still have room under the AGI ceilings, you start using your carry forward, starting with the oldest ones first. It's a first in, first out, or FIFO system.
FIFO for carry forwards. Got it.
Yeah.
One more thing. What if you have both 50% limit property and 30% limit property in the same year, which gets calculated first?
The 50% limit contributions are applied first against the AGI limits. This generally maximizes your current year deduction.
Okay, that makes sense. Let's try to pull all this together with a comprehensive example. That usually helps cement things.
Sounds good.
Let's say we have a taxpayer whose adjusted gross income, AGI, is $60,000.
Okay, $60 AGI.
And this year they make 2 contributions to public charities, $2,000 in cash, and they donate a piece of land they've owned for years, which has a fair market value of $30,000. This land qualifies as long-term capital gain property.
All right, so $2 K cash and $30K FMV land, both to public charities, total potential contribution value, $32,000.
Exactly. So how much can they actually deduct this year, and what happens with any leftover amount?
Let's walk through it. AGI is $60,000. First, the $2,000 cash donation. Since it's going to a public charity, we use the current 60% AGI limit for cash.
60% of $60,000, that's $36,000.
Right. The $2,000 cash is way below that $36,000 limit, so the full $2,000 cash is deductible this year. No problem there.
Okay, one down, now the land.
Now the land. It's long-term capital gain property donated to a public charity. The limit for this type is 30% of AGI.
So 30% of $60,000 is $18,000.
Correct. Even though the land's fair market value is $30,000, the deduction for the land this year is capped at $18,000.
Ah, the limit bites.
It does. So to find the total deduction for this year, we add the deductible cash and the deductible land amount.
That's $2,000 cash plus the $18,000 allowed for the land equals $20,000 total deduction for the year.
Exactly. $20,000 is their current year charitable deduction, but we're not quite finished.
Right, the carry forward. The land was worth $30,000, but only $18,000 was deducted.
Precisely. So $30,000 minus $18,000 leaves $12,000. That $12,000 represents the portion of the land's value that couldn't be deducted this year due to the 30% AGI limit.
So that $12,000 gets carried forward.
Yes, that $12,000 is carried forward. And because it originated from long-term capital gain property subject to the 30% limit, it carries forward as a 30% limitation asset
For up to 5 years.
for up to 5 years, used on a FIFO basis after current year deductions.
Wow, that example really does tie everything together. The property type, the recipient type, the AGI limits, and the carry forward.
Yeah, connecting it all shows how these rules interact. And understanding this allows for, much more strategic charitable planning. You can potentially time donations or choose assets to maximize both the charitable impact and the tax benefit over time.
It absolutely does. So recapping the big picture, it's crucial to know what you're donating: cash, OIP, CGP, who you're donating to, public charity, operating foundation, non-operating foundation, and how those interact with the AGI limits.
And remembering those key exceptions, especially for tangible property use and gifts to non-operating private foundations.
Right. It might seem like a lot initially, but breaking it down piece by piece makes it, well, manageable.
Definitely. And this knowledge isn't just abstract. It's really valuable for anyone involved in tax planning, accounting, or frankly, anyone just thinking about making significant charitable gifts.
It empowers you to be more thoughtful and effective in your giving. So, thinking about all this, what stands out to you, our listener? How do you see these rules trying to balance encouraging generosity while also setting some boundaries?
Or maybe, how might knowing these details change how you think about or plan your next charitable contribution?
Definitely something to consider. We hope this deep dive has helped clarify the sometimes murky waters of charitable contribution deductions.
Remember, understanding these rules is empowering.
Absolutely. And if you want to dive even deeper, get more practice, see more examples on this or other accounting and tax topics, don't forget about resources like farhatlectures.com.
Keep learning, keep questioning.
And keep making informed decisions about your finances and your generosity.